Now that we've done some basic analysis, we now know what is typical for the account and what is an outlier. This raises some questions, such as what exactly is happening in these outlier cases. So what is the cause of these outlier cases, or under what conditions do they happen? For instance, the few cases where we have extremely high volumes traded, what's going on there? What's going on with the excessive long holding period? I mean, to go from a couple of hours to something like 68 days. That's unusual. And what happens in the cases of unusually high and unusually low profits? So firstly, let's have a look at the high volume events. So these are our 0.06 lot volume events, and we see that there are only 4 of them. So that should make them easy to analyze individually. One should also take note that 2 of these end at exactly the same time and are on the same pair in the same direction, and in terms of indexing are right next to each other. The same goes for the other 2. So right off the bat, we see that we can maybe group them and think of them as just 2 incidents. And looking at the first 2 in detail, there we have our 2 0.06 lot deals, and also we've taken some deals before and after just to have a look at what happened around those deals, and we notice that there's quite a lot more deals that have the exact same close time here. Also, we notice that these deals are closed at the exact same price. These are also GBP USD deals, all of them in fact, and are in the buy direction. Now looking at this a little closer, we see that when it comes to when they were opened, they seem to be opened about 1/10 of a cent or so from each other, and we notice that as time goes on, the volume keeps increasing. So it seems that in the beginning we had a GBP USD deal, which was a buy, and we'll notice that as the price moved down, we added to the position. And in fact, at some point, we moved from our relatively normal 0.02 lots to adding more lots. So adding more lots at a time, going from to 0.03, 0.04, 0.05, all the way up to 0.06. And at some point we stopped and we closed all these deals at the same time for the same price, and this was for a profit, a net profit across all the deals. And we'll also notice the first few deals and the last few deals actually are quite high relative to our stats in terms of the losses and the gains. So essentially this is a martingale deal, but okay, let's have a look at the other pair. Looking at that, where is it? There. we'll notice the same thing with a bunch of deals closing at exactly the same time. Oh my goodness, this is a bit, yeah, too fast. Yes, closing at the same time, at the same price, on the same pair, in the same direction, and at intervals of about 1/10 of a cent. The positions being added on as time goes on, and the position goes against us, we're actually adding on, and we're adding on more. So also a martingale trade, and looking at the profits for each individual trade, quite excessive losses, quite excessive profit. So with these two trades, we're already beginning to suspect that this is a martingale strategy. Now, looking at the long holding times and the high or low profits, this basically confirms our theory. So we will find that high profits or high losses seem to correlate with us having some pretty high time deltas, so holding times, difference between open time and close time. And now I do have a few other examples. There's one martingale, I think it was held for 32 days. The Euro USD sell, high losses, high profit, net profit in the end, actually very small net profit at the end. So, and there's another 68-day martingale there closing this time. So we suspect that this deal is trading the martingale strategy. But to make sure, we'd want to prove our hypothesis. So the martingale strategy has the property of progressively adding to your position and not giving up on your position until your net total position makes a profit. And then at the end, you close everything at the same time for the same price. So this is what we're going to exploit to identify martingales out of individual trades. What we do here is group by the closing time. So we consider all deals that were closed at the exact same time as part of a group. We'll just term this a martingale trade or martingale group. Grouping by this close time, and now looking at the profit for each group or each martingale, we have the table shown. So 2,416 deals now, and we have a profit column. Now, since the martingale doesn't give up until it makes a profit, we would expect that most of these deals are in profit. So let's test that out. We take the profits as a list and we run some logic, returning true if the sum of the profits is less than 0 and false if it's greater or equal to 0, and we see that the vast majority, and kind of looks like all the deals, are in profit. So this is essentially looking like 100% win rate. Remember that on the statistics here we had that we have about 78.9% win rate and 21.1% lose rate. But when we think of these deals not as individual deals but as martingale deals or martingale groups, we essentially have 100% win rate. That builds our suspicion there. But it turns out that we have 2 losing trades, and identifying these losing trades, I just wanted to investigate what happened here in these 2 particular trades. I used the date and the fact that the original dataset was ordered from latest deals to earliest deals to identify which index these belonged to on the original dataset, and found the deals. So having a detailed look at these deals, we find that a $1.56 loss closing at 3018. The 3018. There it is. This seems to just be an isolated EUR/USD trade smacked in between GBP trades. Okay, this was a genuine loss. I don't know why the algorithm or trader didn't carry on with the martingale like he kept doing with everything else. And the other one, closing time 15:30:18. 15:30:18. Was that 15:30:18? Or was it this one? 14:31:05. Yes, 14:30:05. That's this deal. 19-cent loss. EUR/USD sell. But we'll notice right after this is a EUR/USD sell again, and the difference between these two is a close time of just 50 seconds, a 50-second delta there. So it kind of seems like this was an attempted martingale, but just missed the timing there. So looking at these two as net, it's a net profit. So I would honestly say that it was only the one deal that was a loss. So this seems to be a very consistent martingale strategy, and the consistency is not surprising given the 92% algo trading. And in fact, I do believe it is the algo trading that allows us to pinpoint all these martingale groups using the close time, because the close times are so exact. They are essentially pinpoint to the second, exactly the same to each other, these close times of these many trades, and the close price. Of course, the same effect would probably be achieved with something like a automatic stop loss or stop order, but that itself can also be considered as an automatic trade, I guess, since it's not manually executed. It's just a condition, and once the condition is met, the action is taken. Okay,